Hey, so welcome back to another episode of Careers and Finance. I am very excited to have Joel Rosen with me. He's a fantastic man and a great guest to have on this show. Joel is currently the head of distribution for Wingate Funds Management, a specialist in private credit real estate operating out of Melbourne. And it's been my privilege to know Joel for a couple of years now and work alongside him. So, Joel, I would love you to give kind of your intro and your story, and would love to hear how you've built your career, and then we'll jump into some finance topics as well.
Yeah, sure, Dan. First of all, thank you for the time and thank you for the great intro there. I hope I don't have to pay extra for that, but I do really appreciate that. Um, but, it goes both ways. And I also, we've had a great working relationship, so really appreciate that. And thank you for having me on
Yeah,
today.
thank you.
From a career perspective, I know it may come as a big surprise, but I do actually come from quite a deep finance background. So, I actually started off, interestingly, in my journey when I was doing my undergraduate. I was actually very focused on corporate and investment finance, but actually thought I'd end up being a derivatives trader. So yeah, it's not that I've deviated too far from the finance path of, good old mathematics when it comes to finance. But it was something that was quite interesting because when I was actually doing my undergraduate, as you'll hear, my accent is obviously South African. Back in South Africa, when I was doing my studies, I actually realized that, as much as derivatives is great, that you can't beat the good old fashioned property when it comes to bricks and mortar. And by doing a lot of, sort of that sort of research when I was actually doing my studies, I realized that, especially in the time in South Africa, and this was in the early 2000s, I guess, just before that big boom that happened in the international property market, that there was a great time to actually enter the property market. So I was quite fortunate that, I got an early start into the property space. And what I think you'll appreciate is that even though I wasn't one of those that was fortunate enough to take a gap year off and travel around the world, and that I went straight into working, at that stage, what was nice about it was that even though it was very much the early stages of when interest rates around the world were coming off these massive highs, a lot of people were starting to make a lot of money in the property space. But in saying that, it was a great opportunity for one to kickstart their career, because at that stage, as you'll appreciate, there was a lot of people going into the early boom in RT, as well as,
Yes.
derivatives, as I was saying to you, but a lot of stock trading. Those were really the popular spaces. Property wasn't necessarily one of those actual spaces. So it was quite interesting that I actually got my first opportunity at a family office to actually kickstart. So once I'd done my honors, as I said, in corporate and investment finance, I actually had the opportunity to start from, one of the largest family operated businesses in South Africa, and actually get to, I think, be really fortunate in that, got that on the ground training really early on. I was also quite fortunate that there was quite a few people that have been really successful in that space and had actually come from a banking background. So as I started my journey there, they recommended that a good space to go into would to be in the property finance side of things, because as I'm sure you'll appreciate, and this will get to where my journey is at the moment, that it's a very nice place for one to use as a stepping stone in their career, because if you're working in the banks and getting exposure to all different types of property lending, it is a great space to actually get those opportunities very early on. And what's quite interesting about when you're doing property finance offshore, which will actually lead into where we go to in terms of private credit in this conversation, is that offshore, a lot of the banks have very different mandates to what we actually have in Australia. So in the bank,
Yes.
you actually can do senior debt lending as well as mezzanine and equity. So because of that, you get a lot of that exposure early on, which is a great space to start your career, because I think I was a little bit fortunate that I was a bit ahead of the curve in that, didn't realize that the market would be suddenly hit by GFC, and that, it would become very ripe for the private credit explosion, which we'll get into. But in saying that, so went into the banking industry post that, and that's really where I got to grips with the whole, if I can call it finance across the stacks in terms of both, equity, debt, mezzanine finance, etc. And from there saw that there was a lot of opportunity in that space, and was quite fortunate in that I was able to, from the banking side of things, actually get an opportunity to join with some funding from a large family office to actually go into the multi-asset space. So we put together quite a large business focusing on, market rent, the BTRs as we call it of today. So I'm sure you
Mm.
can see sort of the trends here. A lot of the stuff that's become really popular of late, I was quite fortunate to get exposure to that very early on in my career. And then from there, really saw that there was an opportunity in the capital raising side, because what you'll appreciate
Mm.
is that if you've been through this whole business journey, one of the key areas is how do you raise funding for these transactions. So as I alluded to, starting out on the banking side of things, getting exposure to, those different sides of the capital, but then also, what is the opportunity out in the marketplace to raise capital from other sources? And because I was exposed to a
Yeah.
lot of that very early on, it allowed me to that by the time I got to, call it just post the GFC and post, being involved in this business I was telling you about, see that there was a real sort of opportunity in the capital raising side. And through that was really able to, especially in Australia, start bringing in a lot of offshore capital for various projects
Mm.
based locally here. And through that, you grow your networks. And again, I mean, we'll touch on it a bit, in this conversation, but that's where it sort of led me into the private credit side of things, because post the GFC, once, lending started getting tightened here, the Royal Commission on the banking sector, you'll appreciate that
Yeah.
a lot of private credit opportunities started opening up. But because I'd had this whole holistic experience along the journey, it sort of led itself very nicely to go into the distribution space, because you are so entrenched in raising capital throughout that journey. So that's
Yeah.
a
Yeah. Yeah.
not so quick summary. So I hope that wasn't in too much detail, but just gives you a good sort of starting point.
No, it's great, and it's actually interesting because it sounds like in a lot of ways you got lucky. Sounds a bit, unappreciative for all the hard work that you've put in, but maybe got lucky in that you found your way into a great stream. You found your way into a great opportunity there through the property side. Wanted to start in derivatives, but found your way. And but transitioning to Australia, property is a massive industry here. And so, how has that kind of transition been for you? And is it largely very similar, kind of South Africa to Australia in terms of property?
So fortunately, I mean, just maybe touching on the South Africa side of things is that because of South Africa's geography, is that you get a lot of exposure very early on to global trends, because there's a lot of intertrade between the US and Europe. So those sort of
Right.
trends are very entrenched in how, the property space works there. So that's why you'll find it's quite easy for a lot of South Africans to then make the journey to Australia and get quite entrenched in the property space, because you're getting exposed to a lot of those similarities very early on. So to answer your question, yes, there is definitely very much so a similarity between Australia and South Africa when it comes to the property space, but that's also very entrenched in the fact that a lot of what the South Africans do is very US based, European based. So
Mm.
because those trends can then be sort of interposed here, and often in Australia, we're a little bit behind the curve. So what you'll find is like the private credit space that exploded in the US and Europe post the GFC. It only really started exploding here once, as I said, after the Banking Royal Commission, those type of things, as
Yeah.
well as, I guess, local economic. So those type of things, we were already exposed to that many years back. It's quite easy for them, from a transition point of view and those similarities I was alluding to interpose that here.
Yeah. Yeah. Nice. And then through your journey, have you had any kind of significant mentors that have really helped you along the journey or helped you sharpen your skills? What role has kind of mentoring had for you?
Yeah, so it's actually a very interesting question, that, because often people ask me that. I do quite a bit of these type of talks, and you'll probably see on my LinkedIn and that, just in terms of nature of the role, that, we do quite a lot of these youth talks, these type of things, where often that's the first question, when the youth are asking a question in these type of events, what should they be, looking out for? And have you had
Yeah.
an actual mentor in your life? the truth is that I've had various mentors. I haven't had a specific one that I could say, this is one person that I relied on for X, but rather I've been very fortunate that I've had a really good, strong set of friends that have been really successful in business. And it's quite an interesting way of looking at things, that I know that it's often, they say it's the company you keep, but because I find that, I've got a strong group of friends based all around the world that have been really successful in very different industries. And because networking is such a key thing that we do in this industry, because you can sort of intertwine that all together and rely on these people to play a bit of a mentor type role. I've also been fortunate that a lot of my friends have been slightly older than me, so can play that role in the process as well. So to answer your question, I wouldn't say I've had one specifically, but if I had to give people advice, I would say find a group of friends that can play different roles as a mentor in different areas of your life as you grow in that journey.
Yeah. I do find that there are some people who have like one or two really significant mentors, but then there are others who have that sort of network of leaders, network of mentors, network of people who are a little bit ahead of where they are, who can draw down from that. So I think, if you can find that mentor who stays in one place long enough and you stay in the same place long enough, like brilliant, amazing, utilize that person for all they're worth, but don't discount, the person you might spend a year with, or the couple of people you might journey with over many years. I think there's a lot of ways you can learn and get mentoring.
Yeah, and not to exactly that, take away the importance of if you can find one single person that sort of ticks all those
Yeah.
boxes. But the reality is I'm just finding that it's such an ever-changing world, and that, not to say that, things that, I think it's almost like human nature that we like to have one sort of solid person that you rely on for, if you can, for many sort of decades and generations. I think a lot of that has changed with the onset of things like AI, etc., where you actually sometimes need impetus even from younger people. So that's why I don't like to say to people, don't close yourself off to just trying to find one single mentor. I think we can get that sort of mentorship relationship from a whole host of different people, because this world is so ever changing at the moment.
Yeah, great point. Love it. And there's so much to learn. I feel like these days, genuinely, you can learn things from anyone within your organization, up, down, sideways. I think everyone's got something to bring to the table, and we are strongest and best when everyone brings their best to that table. So, Joel, we might move on into the world of finance, and I'd love to start talking about one of the channels that seems to be growing right now is the one you operate in, and that's that direct to high net worth individual market. We've had a huge push in the insto space, especially because of Australian superannuation. There's been a big push into advised, but that channel is becoming clogged for various reasons, with the rise of the asset consultants and the halving of the financial advisors in Australia. But tell me about that move into direct market and that space you operate in.
Yeah, sure. So, again, I think this talks around the fact that we often lag international trends here. And, if we actually research this whole private credit journey and actually take a step back and look at what's been happening in some of the other European markets, as an example, the US markets that are a little bit more mature than us in the private credit space, we can often learn a lot. And what you'll find is that there has been a huge shift from some of the largest private credit players in the world into the private wealth space, or individual high net worth, whichever you prefer to call it, purely because what you're finding is that, not to say that institutional money isn't, a great space to operate in. And that's where a lot of the big private credit funds have holistically or historically operated in. But the challenge is that as the world is getting more entrenched in this private credit space and the deal sizes are getting larger, you want to try and find spaces that you can tap into that will stay with you as a fund manager for potentially longer. And so what some of the big US-based and European-based private credit managers have realized is that if they start focusing on the high net worth space, is that you do start to get a lot more people that will stick with you during the journey, or what we like to call in the industry the sticky money. And what we mean
Yeah.
by that is that not to say that, they're less sophisticated or anything like that. It's just that, they're not active day-to-day managers, and it's not their mandate to go, chase around for 10 basis points or 20 basis points. They're happy to stick with you
Yeah.
throughout the journey, provided you're giving them a great risk-adjusted return, as well as, you're giving them all the service and everything like that. So because of that push from some of the big global players into that space, that's starting to transcend into Australia. And also what we're seeing here is the fact that there is research coming out that there's a huge amount of intergenerational wealth that hasn't transferred yet.
Yes.
So we have one of the highest percentages in the world that still has to transfer down over the next couple of years. So
Yeah. Okay.
yeah, so that's why it's such a key focus area for a lot of, even offshore-based institutional, traditional private credit managers to start moving into this high net worth space. It's just that it's a new area that you can tap into that will potentially stay with you longer and reward you for that.
Yeah. And what's attracting so many of the high net worth investors to the private credit space? Like it's just grown and grown, and it's gone from, a few, a few 100 million in the private credit space not that long ago to now we're talking a few 100 billion, and the private investor is making up a larger chunk of that than a lot of other asset classes. What's drawing them to private credit?
Yeah, Dan, I think that's a good question. I mean, the reality is that if you look at the world that we're in at the moment, is we're in very uncertain times. I mean, if you literally, you don't have to just look at us locally. You can just look at us internationally, look at the world where it currently sits. You're not sure what each day is going to bring. Whereas
Yeah.
private credit as an asset class, especially if you're investing in, lower LVR, first covering, if it's in the property space, or even if it's in the corporate credit space where there's, good protective mechanisms in place, it really is a space where it can give investors a nice risk-adjusted return. It's not something that, from a
Mm,
credit perspective, that you're going to be shooting the lights out. It's not something that, is those historic, and I wouldn't even say historic because you're also seeing it now even in the crypto space, those type of returns that you're getting, but it's just something that's really stable. And it's hard to find stability in these uncertain times. So to answer your question is, I think what we're finding now is that a lot of people want stability. And this is a space where you can give investors a stabilized return without incurring a lot of risk. And especially, even in spaces like self-managed super funds, those type of spaces where, there
yeah.
isn't this huge amount of, flexibility when it comes to product type. Where do you put your money if you don't want it in a cash deposit? So you need to find these type of alternatives. And so because of that, I think that's where you're seeing this large shift into the space. And also because, the reality is there's good opportunities as well from, a return perspective, in that the banks are still very much, yes, they're definitely returning, but they are mandated in terms of what they
Mm,
can and can't do. And there will be this, pipeline for a long time, if not forever, of an asset class that stands on its own and offers investors this type of return. So I think people are getting educated in that space as well. So it's a couple of things. I mean, as I was saying, is wanting that risk adjusted return. It's the fact that,
mm.
now people are more familiar with the asset class and seeing what's been happening offshore. So there's a number of these type of things that we're seeing a lot of interest. And what's quite interesting is if you look at how private credit has evolved in the country, is that traditionally, a lot of the big credit managers have been Melbourne, Sydney focused. That's also
Yeah.
starting to widen in itself. So you're seeing a
Mm,
lot of new interest from where you sit yourself in Western Australia, but in South
yeah.
Australia, we're seeing a lot of new potential high net worth investors, as well as Queensland, as well as even up into the Northern Territory. So you're starting to see a much wider market evolving. And those are sort of those trends, and those type of people haven't traditionally had access to these type of asset classes. So I think it's a lot of those
Mm,
type of things at play. Also, you would have seen in the recent press where, things like hybrids no longer will going to be phased out over the next couple of years, those type of things. So there's a lot of
yeah.
those type of impacts coming through.
Yeah. Yeah. And on that pace of kind of risk adjusted returns, I used to be a financial advisor. I would try my best to explain nerdy things to my clients like standard deviations and how far, a 9% average in Australian shares, like, what is still considered normal. And it was roughly 0 to 18, uh, was still in that one standard deviation range of normal. Kind of, what are you saying in private credit as being maybe an average range of return and an upper and a lower sort of band in that? What are you seeing?
Yeah, so I mean, just from a Wingate perspective, I mean, as you'll appreciate, we were recently bought up by Capital Land, which, large
Mm,
Singaporean real estate manager. So, we very focused in the risk-adjusted credit space, and that
yeah,
generally, open-ended funds at the lower LVRs first covering security in the property space, you're looking at around, your 8% type of range, but that would be
yeah,
open-ended and have liquidity and that, investors can exit in a short period,
yeah,
like 30 days, up to, your more close-ended type products in about the 12, 13% range per annum. So that's
yeah.
pretty
Wow.
much the band where we operated. Again, anything over in this market, now that the cash rates come down, anything over 10% does incur extra risk, and I'm assuming would have some form of extra premium on the LVR space for that. But that's
Yeah,
generally where, we see that the market at the moment. It's not to say that there aren't equity type products that can go in excess of that. But again, then, you're playing in the equity space as opposed to a bit more in the traditional credit space.
yeah, yeah. And that's a pretty tight range of returns, on that risk spectrum, maybe within private credit. So I can see why a lot of investors would be very interested in hearing about that. Are you finding any preference around where those deals are being allocated in terms of, would people get more excited for a private credit deal that's, based out of Sydney versus Melbourne versus Perth versus Brisbane?
Yeah, I mean, it's a good question. Of course, Victoria has its issues, we all know at the moment, but it doesn't mean to say that there aren't great opportunities here still. So we definitely still focus here. But, in terms of the wider portfolio, the key focus areas, especially in our, property space, have been in your New South Wales, Queensland, Western Australia, South Australia, because, there is a lot more in terms of an investment when it comes to, a lot of these economics at play in those regions
Yeah.
versus what we're seeing in Victoria. But as I said, it doesn't mean to say that there aren't opportunities here. But certainly I would say, pretty much at the moment, if we look at, like we've got a senior debt fund, that's probably in like your
Mm,
30% top range based in Victoria, where, the rest of it would be across the country. So there's, a lot more opportunities, fortunately for us, on a national basis, so you can give investors that diversification, because that's also, one area where people need to be conscious of, especially in the private credit space, is that a lot of managers may be, traditionally Victoria based, because that was where the start of this whole private credit boom arguably started, as well as New
yep.
South Wales. I better say that up so they don't shout at me. But in saying that, in saying that, is that you'll find that a lot of these managers are very heavily focused in Victoria. We've tried to have a bit more of that national approach, and I think that that's standing us in good stead on that basis.
Yeah, great, great. And as you look ahead, well, even currently, but as you look ahead in the next kind of 1 or 2 years, what challenges are you seeing in the distribution space?
Yeah, I guess the real challenge is to be able to raise capital is quite a unique skill set. And I'm not just saying it because I'm in the space. So it's just that, what you'll find is what I was talking about in terms of my journey, as you maybe touched on, but fortunate in that I've had exposure to so many different parts of the private credit story and the journey to get here.
Mm,
It's hard to find people that have, sort of the experience where they can go and sit on the other side of the table, where they've been involved in property transactions or corporate credit transactions. And as private credit's evolving, is that there's been a lot of movement out of real estate into corporate credit. So where I see the challenges coming in is
mm,
to find people that have experience in property as well as corporate credit, and, as I've touched on, open-ended funds, closed-ended funds, senior debt type products all the way up to pref equity. So there's a lot of moving parts in that space. And not to say that there aren't great, operators out there, but there's also, a limited amount of people that have had the chance to get many years experience in the space. I've been fortunate to be, in the industry now for over 15 years. There's not, that ability to have that type of experience. Still, I mean, Wingate fortunately has been going for 21 years, but it's one of the oldest operators and was one of the pioneers of this one. So a lot of the guys, it's a lot newer. So the challenge comes in is to find more people that also want to go into distribution, because, it is very much a sales type space. So you need people that understand all that technical, political side, but then also have the sales experience. So I think the challenge is going to be finding more people to raise capital, and not only locally, even from an offshore perspective. There's a huge opportunity like we have with, Capital Land being our owner, to bring in Singaporean high net worth families, those type of things.
Yeah.
You need people that understand how it works on a global perspective and those type of things. So I think, that's where it's going to be interesting, is to see how the distribution space, sort of evolves over the next couple of years, because I can tell you from what I've seen in the industry, and I mean, you would be better placed to echo this, but it seems like that's where the challenge is probably going to be on the staffing side of things, I would guess.
And it's a challenge whenever you've got such a rapidly expanding pocket. Private credit, as you rightly mentioned, largely exploded off the back of the Royal Commission in Australia. And so what that means is, that was 2017, the Royal Commission, but it really was probably 2019 when it started to filter through. So that gives us all of 6 years. So for a BDM to be considered like senior in most places, they've probably got 10 years experience. Private credit really only has 6 to 7 years in Australia at any sort of scale. And so, to your point on finding those right people is definitely a challenge. And there's a battle for the experienced ones that I deal with all the time. That's my line of work. And I think finding those ones who have got, a solid basis in it is going to be key to growing organizations, and especially as the space becomes more competitive. Though at the same time, I think there's still a lot of room for growth. We're still in a phase where I think it's getting competitive, but there still seems to be a lot of room at the table for everyone. I don't think we've hit that saturation point yet, but there you go. And mate, I guess on the flip side of that, where do you see the most opportunity for growth over the next 3 to 5 years for private credit as an industry, but perhaps also, for distribution?
Yeah, so Dan, I think what's going to be quite interesting is this whole corporate credit space. So if you're looking again at how private credit has evolved internationally, is what you've seen is that, of course, real estate will always hold its own and is a key space and will continue to generate good returns. But there has been a huge movement by some of the biggest global private credit managers into corporate credit. And what I mean by corporate credit is very similarly to how private credit evolved here, from lending to, well-known property developers as the banks became less involved in that space. The same thing is happening in the corporate space. So you're seeing really good Australian corporates have really good, opportunities to grow, but they're just not getting that same servicing from the banks. And I think that's going to be a really big market that's going to continue to grow off the back of what we've seen in real estate, because it's very similar in terms of how it works from the private credit perspective. If you can find really good sponsors that you're lending money to, and that, there's really good financial covenants in place as well as good security, the economics are very similar. And you're finding that there are some really good fund managers focusing in that space, notwithstanding Wingate's got a really strong team, but there is definitely an emergence of this with even some of the bigger global corporates that are starting to focus more and more here. So I would think over the next 3 to 5 years, you're going to see real estate continue to grow, because even that part of the market here is still a lower percentage versus what you're seeing in the US and Europe. So that's definitely got some growth. But then I think you're going to compound that with the growth, which is still enormous in the corporate credit space, because as you'd imagine, Australian corporate landscape is massive. And, the deal sizes that some of the global private credit champions are chasing at the moment are, in your billions and billions of US dollars. So, there's a lot of scope there still, I think, in this space. So I would think those are where your trends are going to be. I think that there is going to be flight of assets to safe haven sort of larger managers. So there may be some consolidation in the industry. I mean, there's the asset review coming out. So there has been an emergence of, smaller operators. What you might just find post that is, that there's a bit of consolidation towards your larger managers with a bit more returns may not be as high, but it's a bit more risk adjusted with better, compliance and all those type of things. So I think that's also going to be an opportunity, and I guess a bit of a threat for, if you're a smaller type operator, but definitely an opportunity for those that can, right off the back of that. So I think those are sort of the trends that we're going to be seeing over the next 3 to 5 years.
Yeah. Yeah. And that corporate credit space, I'm not as familiar with it, aware of it, but not as familiar, because it would seem to me that they probably don't have the same level of security. Like when you're in the real estate space, you sort of know the asset you're taking for first mortgage over. How does corporate credit kind of de-risk itself in the same way that property can?
Yeah, it's a very good question. But the truth is that's where it comes down to the fund manager and the team you're dealing with, because there are mechanisms in place, very similarly to how the banks are able to lend in that space, to get very similar security. And what I mean by that is that, for an example, there might be a large US multinational that wants to invest into Australia, and wants to expand, but they don't have a track record here. So one of the local banks won't provide them a facility. We can, from a corporate credit, private credit player, go and take some form of US multinational parent company guarantee, which is a very strong guarantee that would be very similar to something like you would have on a first covering mortgage. That's one sort of way you could do it. Another way you could do it is, besides the guarantee side of things, is that if you're lending to a business that is in, say, manufacturing of stock, you can take a first charge on the security of the actual stock. Of course, you've got to be careful in terms of what the values are there. So you would want it to be on some form of realized liquidation value that you're placing your LVR on. So, that's where you've got to be very careful. But there are ways in the corporate credit space to have very similar security from a senior level that you would have in the property space. Of course, we're always familiar with first covering mortgages in the real estate space, so that always comes to mind as the safe haven. But with good credit managers, you are able to get very secure senior debt positions on a very similar basis based on ways that those deals are structured. There's a whole host of mechanisms that the teams would look at to put in place to give that same form of comfort. And that also comes down to the operators' credit and investment committees that they have in place, ensuring that those covenants are in place when lending to these corporates. So there's a whole host of mechanisms that one can put in place.
Yeah. Yeah. And then, Joel, last question I want to ask is, you mentioned the ASIC kind of process that's going on. If you could, not that we ever get to choose, but if you could choose, what the industry benefits from, there could be a fear-based approach to it, but I think at the end of the day, private credit's an emerging industry. ASIC need to get involved at some point and make sure that the dodgy little players out there, are abiding by the rules and whatnot. But what would sort of be your hope as to what comes out of that process?
Yeah, I mean, look, we all in favor of good governance and, good regulations in place. So I'm hoping that from that just comes a clear framework that the bigger players like ourselves that already have big institutional mandates, as well as, have an owner like a Capital Land that went through a detailed due diligence, have already in place, are just mirrored in other organizations, just so that the industry can be cleaned up from the perspective of not being tainted by, which is, often not true, because in some cases we even feel we overregulated some of the time. But it's really to just get that across the industry so that it just takes away, that investor haste of reading these articles and then, feeling like that there may be something there. But I think it's a really good thing, because I think the industry needs it. And I think through this process, it will help managers like ourselves who have these policies and procedures in place be able to utilize the marketing of that better, because you will find that some of the guys that don't have that in place will not be around post the process.
Yeah. Yeah. Awesome, Joel. Well, mate, it has been a fantastic chat. Thank you so much for joining me on Careers and Finance, and look forward to our unfolding relationship and next conversation.
Absolute pleasure, and all the best as always.
Thanks, mate.
Great stuff. Cheers.